Powell was just looking for any excuse possible not to risk putting the economy into a recession. So instead, he risked something much worse. Remember, I said that Powell was betting the farm on transitory, that he basically went all in and bet the entire country because I said if Powell was wrong and inflation wasn't transitory, he would have let a genie out of the bottle that he had no chance of ever putting back in, and it was going to do massive damage to the US economy. Well, the Japanese have a similar inflation genie on their hands, but the Japanese have been creating this inflation problem for better than 30 years. So when it comes time to pay the piper, it's one hell of a bill because they had a huge bubble in Japan during the 1980s in the stock market and in the real estate market. And the reason for that bubble was that the Bank of Japan kept interest rates too low. The main reason was to prevent the yen from rising too much against the dollar. Now, the yen went up, but it would have gone up even more but for the inflationary policies of the Bank of Japan. Now, this was misguided. It was their attempt to maintain the U.S. as an export market for the United States. So they artificially suppressed interest rates. The problem was it created a stock market bubble and a real estate bubble. These were very similar to the mistakes that the Federal Reserve made in the latter part of the 1920s when they tried to prop up the British pound, and that excess liquidity went into U.S. stock and bond prices. Well, the same thing happened.
Did you hear that Japan is thinking about exporting back the inflation it had once imported from the U.S.? Times are bad for every country. However, Japan tried to keep its interest rates down while coping with inflation at the same time. But now it has to change its over 4-decade-long monetary policy, and it has. Well, this doesn't come free of cost. The U.S. has to pay for that, and this time, the U.S. will be the losing party. But what's the bomb Japan has dropped about which Peter Schiff is talking about? Well, there are 2 bombs in total, both of which will give Japan leverage while offering only losses to the U.S. These bombs will transform the U.S. market and make the economic decline in the U.S. worse. Let's find out what Peter Schiff has to say about the economic bombs Japan has dropped on both the market and the U.S. Watch the video until the end to know Americans will suffer this time. Let's get started. For about the past 40 years, Japan has been following a quite dysfunctional economic policy. However, due to a reason. This policy says that the yields on the Japanese government bonds should be low, while the inflation should grow for economic growth. However, as Peter Schiff said, both of these principles are flawed. First, any government cannot keep the yield levels down artificially, and if it is doing so, it is playing its role in a future economic decline. If yields are kept low, no one will buy the Japanese government bonds because simply the yields are so low. Inflation is more than the yields, therefore people don't want to give up their purchasing power. So Japan had to print more yen and buy those bonds, which created more inflation. However, Japan didn't consider this a problem because it was following the same inflation doctrine every other country was following. The Fed and all central banks around the world believed, and still believe, that the higher the inflation, the more economic growth. However, this is just wrong. Inflation, to some extent, is good, but higher inflation just paralyzes the economy. High inflation limits consumers' spending, so not much money is spent. At that moment, Japan felt the problems worsening because people were not buying the 10-year Japanese government bonds, even they were selling them. So Japan had to print more money to buy those bonds and create more inflation. All that was a perpetual loop where Japan would print more money to buy the bonds to keep the economy stable. It was just a futile exercise because that's not how economies work. Therefore, now the Japanese government has announced that it will increase the yields from 25 basis points to 50 basis points on 10-year Japanese government bonds. In other words, overnight, the yields have doubled, thus encouraging people to buy Japanese government bonds. However, this is still lower than the inflation. Therefore, Japan has to increase the yields even more. But why Japan isn't increasing yields when naturally they should have increased? Here's a little reminder to like the video if you were loving it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. Well, the reason is Japan doesn't want to offer higher yields and save them for the country because it has a massive debt. Japan's debt to GDP percentage is 270%, more than double that of the US. In other words, the debts on Japan are about 2.7 times more than its GDP. To cope with them, Japan has to pocket the yields instead of offering them to people who are buying Japanese government bonds. But interestingly, Japan has high debts because it prints more yen to buy back its bonds. And to avoid those debts, it has to lower the yields, which again forces it to buy more bonds. That's a perpetual debt crisis Japan won't get out of until it does something big. Earlier, Japan's monetary policy was, inflation is good for the economy. Therefore, Japan should take inflation to heights. But that's flawed because nothing like that happens. Increasing prices don't strengthen the economy but limit consumer spending. But when prices decline, people are willing to spend money on everything, driving economic activity and pumping more money into circulation. Also, when interest rates are high, people invest and save their money, which becomes an economic driver. But Japan was doing exactly the opposite of both of these things. Listen to what Peter Schiff said.
I've been talking on this podcast about the ridiculous yield curve control policy going on in Japan right now, where the Bank of Japan has committed to keeping the yield on a 10-year Japanese government bond at 25 basis points. Now, given that inflation is well above 25 basis points, nobody wants to loan money to the Japanese government at just 25 basis points. So the only way to keep the yield that low is for the Bank of Japan to buy the JGBs that nobody else wants. The problem is, in order to do that, they have to print even more yen, creating even more inflation, therefore creating an even greater desire to sell Japanese government bonds. And that is the no-win scenario that the Bank of Japan faced. The reason that people don't want to buy 10-year Japanese government bonds that yield 25 basis points is because inflation is much higher than that. But the only way for the Bank of Japan to keep rates that low is to create even more inflation to buy those bonds. So it's like a dog trying to catch its tail. It's never going to do it. Well, on Monday night, the Bank of Japan announced that it was raising that yield target from 25 basis points to 50 basis points, basically doubling the yield that it would allow on Japanese government bonds overnight. And of course, that immediately sent yields surging. They haven't hit 50 basis point yet. The highest I saw, I think, was 45 basis points. As I am recording this podcast now, I checked where the yield closed on Friday, and Japanese government bonds went out at 0.37 yield, so below the 50 basis point ceiling. But I believe that before too long, the yield on the 10-year JGB is going to be stuck right at 50 basis points, the same way it used to be stuck at 25 basis points, because the yield is still too low. The government is artificially suppressing yields, and so everybody is going to want to sell. The only buyer of those securities is going to be the Japanese government bond. They actually realized this because at the same time they announced that they're going to allow the yield on the 10-year JGB to go from 25 basis points to 50 basis points. They also announced an expansion of their quantitative easing program. Talk about mixed signals, because those policies are at odds with one another because they're tightening and easing at the same time. But I think they realize that there is no way to maintain 50 basis points. They couldn't maintain 25, and they won't be able to maintain 50, which is why I know they're going to go up to 75. They're going to go up to 100, because the Bank of Japan is going to have to create just as much inflation to artificially maintain the yields at 50 basis points as they did at 25 basis points, which means eventually they're going to give up. In a way, what the Bank of Japan did was a pivot, because everybody has been waiting for the Fed to pivot. Nobody noticed the pivot in Japan, because up until now, Japan was the last holdout of the major central banks because they weren't fighting inflation at all. In fact, by pegging the yield on a 10-year JGB at 25 basis points, the Japanese already decided that higher inflation is better than higher interest rates. Well, the problem is, if you have higher inflation, you're going to have higher interest rates. And the more yen the Bank of Japan prints to buy JGBs to prevent higher interest rates, the higher the inflation rate is going to rise. The reason higher interest rates are such a big problem for the Japanese government is because the Japanese government has so much debt. The Japanese government debt to GDP is 270%. That's twice the debt to GDP in the United States, even if you include the state and local governments. 50% of that debt is owned by the Bank of Japan. And the reason the Bank of Japan owns all that debt is because they had to print all this yen to buy all those bonds, because according to the Bank of Japan and the government of Japan, remember Abenomics, the whole purpose of Abenomics was higher inflation. The economic theory in Japan was that we didn't have enough inflation, that if we only had more inflation, we'd have a stronger economy. That, of course, was an asinine theory, and I pointed out the absurdity of it in real time. Of course, it's the same nonsense that we're getting from the European Central Bank, from the Bank of England. Even the Fed bought into the idea that we need inflation in order to have economic growth, and we can't risk deflation. That's the worst possible thing. So the Japanese government was deliberately creating inflation because they said it was too low. And in fact, if you look at where inflation was in Japan, going back to 2015, the inflation rate averaged between 0 and 1% a year. So they weren't even near 2, because they were not even at 1. We had a couple of points in 2018 where the year-over-year rate got above 1%. But in fact, in 2021, the rate actually got to negative 1% year over year. So they actually slipped into the dreaded deflation. They had falling prices. Now, of course, all hell didn't break loose in Japan because the cost of living notched down a little bit in 2021. But of course, when your policy is 2% inflation, you freak out when you get a -1. And so they kept on printing and printing money. Well, now the non-existent problem of too little inflation has become a very real problem of too much inflation. I've explained many times on this podcast why it's absurd to believe that low inflation is a barrier to economic growth. The idea that nobody is going to spend unless prices are rising is absurd. And first of all, economic growth doesn't come from spending. It comes from the opposite of spending. It comes from underconsumption, savings, and capital investment. That's what grows the economy. But to the extent that you want to look at the demand side of the economy, the best thing to help demand is when prices go down. Because when prices go down, you could buy more. As we're learning right now, prices are rising and it's destroying demand. Because as prices go up, people spend more money on the necessities and they have less money left over for everything else. But if you had a declining cost of energy, if you had a declining cost of food, if rents were going down, if a lot of your costs were going down, that would free up purchasing power to buy more stuff. So falling prices promote economic growth, not the other way around. People don't have an unlimited amount of money, and the cheaper things are, the more stuff they could buy. Businesses aren't even hurt by falling prices, because if their costs are falling along with prices, they maintain their margins and they make a greater profit because they have higher volumes, because they can get more sales at lower price points and therefore earn more money even if the prices are lower. So it's all nonsense that we need rising prices to have a growing economy. And part of the reason for the fear of falling prices is they go back to the Great Depression and they look at the fact that prices went down during the Depression and we had a depression, and they make the faulty logical conclusion that it was the falling prices that caused the depression. There is no logical connection between those two things. Just because they happened at the same time doesn't mean one caused the other. And in fact, if there is a causal relationship, it's the other way around. It's not that falling prices caused the depression, it's that the depression caused prices to fall. And it's a good thing that they fell because that eased the burden of the depression. Looking at the depression and looking at falling prices and concluding that we had a depression because we had falling prices is like looking at wet sidewalks and saying, aha, the reason it rained is because the sidewalks are wet. They have it ass backwards, but it's this fear over creating another Great Depression that is one of the reasons that politicians are justifying their avoidance of deflation at any cost and their pursuit of inflation as if it's some kind of holy grail.
But now Japan knows all its policies won't work. And that's where it is all set to drop bombs on the market and the US. But how? Well, let's find that out. Japan knows high inflation is no longer better because it seizes economic activity. So what should it do? First, it has to bring the inflation level down. In other words, it has to reverse what it has been doing for the past 30 years. And to bring inflation down, it has to increase yields on its Japanese government bonds and lower the money supply. And guess what? Yields on bonds have started to increase, and the Japanese government will continue to increase that. And as for the money supply, the Japanese government will take a decisive step and hurt the U.S. economy for its own benefit. The Japanese government currently has U.S. Treasury bonds worth $1.3 trillion. If they are sold and Japan gets the USD, it will have an influx of capital that was earlier seized. After getting the USD, the Japanese government will sell them and buy yens, strengthening it for good. A strong yen means inflation will go down because the prices of all goods will go down. As Peter Schiff said, decreasing prices encourage people to spend on everything they want, driving the economy. On the other hand, Japan will pay less for all its imports because its yen will be stronger. Not only that, but these yen could be used to buy Japanese government bonds, decreasing the national debt. All those yen that have come from selling bonds will eliminate Japan's 13% national debt. At the same time, those yen will be eliminated from the supply, shrinking the money supply. But the US will pay the cost for Japan's flourishing economy because the US treasuries will be sold. This will devalue the US treasuries because the market will be flooded with them. So the same problem Japan faced will now be exported to the US. And people shouldn't forget that the Japanese could pay higher prices because they are wealthy. But that's not the case with the Americans. That's the bomb Japan will be dropping soon, according to Peter Schiff. He said that he thinks Japan is already selling US treasuries and USD. At the same time, one bomb has already been dropped, that is, the increasing yields, which will make Japanese government bonds quite lucrative.
Kind of like ripping a Band-Aid off versus slowly peeling it off. The free market rips off the Band-Aid. What the government does is peels it off slowly. And in fact, if you want to judge the success of this interventionist inflationary policy, just take a look at the Japanese stock market, because it peaked in 1989 at just under 39,000. And if you look at the price today, 33 years later, it's 30% lower. And now, obviously, these stocks have paid dividends over the past 33 years, but the price is 30% lower 33 years later. That is an abysmal failure. And to put into perspective just how big the Japanese stock market bubble got when it peaked, if you look at the beginning of the rise, 1950, to the peak, 40 years later, 1989, if an American investor invested 10,000 US dollars in Japanese stocks in 1950, at the high in 1989, that $10,000 investment would have been worth $12 million. Now, $4 million of the $12 million was from the appreciation in the stock. The other $8 million was from the tripling of the value of the Japanese yen relative to the US dollar. In contrast, if an American investor invested $10,000 in the Dow Jones in 1950, at the same point in time in 1989, that 10,000 would be worth 135,000. Again, I'm not counting dividends, I'm just looking at the price appreciation. But 12 million in Japanese stocks versus 135,000 in US stocks. That is an enormous difference. Now, all of that wasn't the bubble, but a good portion of it was. But I believe had the Japanese government not intervened after the bubble crashed and allowed the free market to function, not only would the Japanese economy be far stronger than it is today, and the Japanese standard of living much higher, and Japanese government debt to GDP significantly lower, but I also think the Japanese stock market would be significantly higher today than its 1989 peak. But unfortunately for the Japanese, the government intervened to try to protect them from a recession, and instead they got something much worse, and now they have an even bigger problem because instead of just slow growth, they have inflation. Now, one solution that the Japanese have that we don't, and it doesn't solve the whole problem, but it's a start, is they could sell their 1.3 trillion of US treasuries. Because if they did that, then they could take the dollars they get, sell them, get Japanese yen. That'll push up the value of the yen, which will help bring down prices, especially for imports. Then the Japanese government could take those yen and buy back JGBs from the Bank of Japan, basically retire that debt. And then the Bank of Japan takes that money out of circulation. And so the Japanese money supply shrinks, and 13% of the Japanese national debt gets eliminated. Now, that would fight inflation, and that would come at low political costs in Japan, because instead of asking the Japanese to pay to fight inflation, they would be asking Americans. Because one of the reasons that the Japanese owned so many US treasuries is because they wanted to prop up the dollar. They didn't want the yen to get too strong because they wanted to maintain their exports to the United States. Well, we've just had a huge crash in the value of the yen. They need a stronger yen if they want lower inflation. So what they need to do is take our inflation that they imported and export it back to the United States. So the problem, of course, for America is that this solution for Japan just makes our problem even worse. Now, are they going to rush out and sell all of their 1.3 trillion in treasuries right away? No, but they're not going to buy any more. That's for damn sure. And I think they're already selling. And I think they're going to pick up the pace of selling treasuries because it is the most politically viable way to begin the inflation fight. Now, I don't know that they can win the fight just by selling US treasuries, but it's the best way that they can start. And they can't win a fight unless they get in the ring. And the best way to do that is, again, selling dollars, selling treasuries. But when Japan throws that punch, it's the US economy that gets knocked out. But even before Japan becomes a significant seller of US treasuries, Monday night's pivot to allow the yield on the 10-year JGB to rise indicates that the Bank of Japan has now joined the tightening party, having been the last holdout from that party. And this is going to further complicate the US stock market and the US bond market because Japanese liquidity, which has been helping to prop up global markets, is now being withdrawn, and any assets that have been floating on that liquidity.
What do you think? Will Japan sell the U.S. assets to get economic stability? Wouldn't the U.S. feel resentment if Japan did so? While selling U.S. assets means the devaluation of the USD and a decline in the U.S. economy. Comment right below in the comment section. Do you see any other way for Japan to get out of the debt and inflation crisis? Do you want to watch more videos like this one? If yes, please like and share the video and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.